You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, we're back in again for another week, Young Investors Podcast. It's number 65 today, so we're getting through them all right.
Cracking on.
Yeah.
What do you reckon? What do you reckon's the next big milestone? What do we? When can we say, hooray? We've reached
probably
a new milestone?
66.
66? Yeah, that's exactly what I was thinking. Yeah, 66 or 67. It's one of those two.
One of those. Nah, I think it's got to be 100.
100?
Yeah.
Surely 75.
Nah, 75's boring.
Oh, okay, fair enough.
Like if you get a score of 75 in cricket, you don't raise your bat. That's when we know we got to do something big.
That's an excellent an excellent point to make there.
If the podcast number is a time where is a runs amount that a batsman would raise their bat, then we got to do something big.
Yeah, definitely. I think when we get to 75, we can talk about it. We can be like, hooray, we reached 75. But when we get to 100, we'll do something.
Yeah, we got to do something. I don't know.
We'll figure it out.
What should we do? Do some like we got to. We'll at least meet up.
Yeah,
we should do something cool though. I don't know. We'll figure it out when the time comes. We're still a fair way away.
Yeah, it's not something we have to. Yeah, how far away are we? We're at what, 35? It's at least 35 weeks, and knowing us, that's probably more like 40 weeks.
40 something. Yeah. Yeah, exactly right. Anyway, what have you been up to? You've been up to much? You've been buying anything? Market's been down this week. It's been tanking like crazy.
Yeah, this week I haven't been buying anything, which is kind of usual. I don't really buy that much very often. But yeah, market's down a little bit. I had one of the companies in my portfolio reported their earnings last week, but we just missed it with the podcast. Yep. So that's pretty much what's been going on with me. What about yourself?
So since the 20th of Feb, the market's it's only down like 7%, which is still a decent amount.
It's a decent move.
But I mean, considering like where it was before it started going down, it's probably not. You could probably make a strong claim that the market's very overvalued even now after it's lost 7%.
Yeah, that's the thing. Like even at the start of or the end of 2018, was it when the markets went down maybe 15% or something? Even back then, I was kind of in the position where I thought, yeah, they're cheaper, but are they cheap enough? And now today it's just, I mean, it's always an interesting debate when something like this happens because people say, oh, stocks are on sale because they're 7% cheaper now. But is that really the case?
Is it the case?
Is it?
Good question. Yeah, back in at the end of 2018, so it was from the end of September through to the end of December. From the high to the low was negative 17.5%.
Wow.
Which I think made the stock market or the S&P 500 I'm talking about finish down about 6% for 2018, I think. Because like you look at the rest of 2018, it was just surging up. It was only really at the end where it lost that big chunk, which actually made it finish down slightly. And then since then, it's just been on a rampage.
Yeah, and it's quite interesting and kind of, I guess, scary as well for some people how quickly those gains could be erased. So you have 9 months of the year where the market's roaring, and then in 3 months it gets wiped out plus some. And you could have imagined if that continued for another couple of months, you could definitely have seen the market down like something like 30% if that was kind of the start of some recession. And it can be so quick that it can just turn.
Yeah. And I think that's why I like listening to people like Warren Buffett in these kind of times when he gets asked, what's the market doing? I know we're going to talk about this later because he's come out with his shareholder letter recently. He just comes out and he says, yeah, look, people are going to start talking. There's going to be short-term fears. People are going to scream that a recession's coming or whatever, but at the end of the day, you just got to think, well, what's the outlook going to be for not the next 3 months or month or week or the next day, but what's the outlook going to be for these businesses for the next 30 years?
Yeah.
So, I mean, it's just good to hear someone like Buffett talk at a time where the market's like starting to tank, because he just totally like helps you keep you cool and just be like, yeah, just remember that you're buying a business, or you're buying a collection of businesses if you're buying an index, and you got to remember that the way to make money is to stay focused on the long term and decades into the future. And like in his most recent interview, which I'm sure we'll get into, he was being quizzed on, what do you think about the coronavirus? The coronavirus is going to be the end of the world until a couple of months from now. And he said, look, I don't really care what's going on. Well, it's not, he didn't say he doesn't care what's going on with the coronavirus, but his sentiment was, these things happen sometimes. And when it comes to investing, then you always just got to keep your eyes on the horizon, that kind of two-decade outlook, and from his perspective, this will not have a significant impact of where these businesses that are affected will be in 20 or 30 years. So he's still optimistic.
I mean, the coronavirus, the effect that it's having on businesses maybe over the next 6 or 12 months, that only matters if you need to make a profit in the next 6 to 12 months, which is the case for many big fund managers who have their investors and their managers sort of tapping them on the shoulder, asking them what their returns have been in the last 6 days or the last 3 months. But for the long-term investor, someone who has a much longer horizon, you're exactly right. It really doesn't matter. As long as it's a strong business, it's not going to have long-lasting impacts on their profitability.
I just did a post over on the Profitful Facebook page because I found this interesting. I saw a chart which compared the sentiment of financial headlines versus the price of the S&P 500. And it's pretty crazy that, if the S&P is going up, the line of sentiment is going up and up and up, getting increasingly positive. And then when the S&P 500 is going down, the line of sentiment is getting increasingly negative.
Yeah, and those two things kind of feed into each other because the media is always trying to run off fear or excitement. So when the stock market's roaring, there's going to be a lot of articles suggesting that it's going to continue and it's so exciting. But it also kind of goes the other way as well because when there's sort of a lot of media attention around some kind of recession or whether it's the market going up, that also drives investor decisions and also sort of adds back. It's kind of, they both kind of work with each other in a feedback loop in both directions.
And it's pretty interesting that as a long-term investor, when you look at a graph like that, you should actually be thinking the inverse. It's like when this S&P 500 is like breaking new highs and, absolutely screaming up, you should be getting less and less excited if you're going to be a net buyer of stocks over the next 30, 40 years. It's when the S&P 500 or the market, whatever market you're looking at, is starting to go down, that's when your excitement should be increasing because you might get the opportunity to buy the businesses that you're interested in at cheaper prices. So I find that interesting. It's just crazy. The media will swing up and down with their headlines as the market does. But as a long-term investor, your thought process is probably the inverse. You're getting bored when stocks are going up. And you're getting excited when they're going down.
Yeah, and we can talk about a little bit of a case study that I sort of experienced over the past 12 months. And this is kind of relevant today because the company that I'm talking about, Texas Roadhouse, just had their full year earnings come out last week. And we just missed it on the last podcast. So I thought maybe we'd talk about it this podcast.
Let's talk about it.
But before I get into the earnings, I guess, just to sort of relate back to the how stock market movements can be so irrational. The stock last year, this is pretty much entirely based on fears out of rising minimum wages. The stock went from about $75 a share to $49.
It's a big drop.
And then today, or after the earnings came out, not today, but after the earnings came out, it was back up at 71. So it went down 75 to 50 and then back up to 70 within the space of about 18 months or 12 to 18 months. I fortunately was able to, a little bit of luck, a little bit of skill, I guess, as well. But I was fortunate enough to pick up some shares at around the 50 to 55 mark because that's what I thought was, a good deal.
Yeah, and based on all the research you've done too.
Yeah,
it's not like, I mean, you're modest in saying that maybe a little bit of luck, but at the same time, you put the effort into, do the models of what you think the business is worth, which is obviously such an integral part. So, of course, it's always going to be unpredictable what the stock price does in the short term. I think that at the end of the day, it's definitely based on you taking advantage of prices that you deem to be cheaper.
Yeah, I definitely felt very strongly that at the price that I purchased it, over the next 10 years, the stock would do very well for me.
Right,
the luck component is kind of the timing of that.
That it happened now.
Exactly. Did I know that it was going to bottom out a couple of weeks after I purchased? Of course not. And in fact, I kind of would have liked if it didn't, because that wasn't it wasn't at the price that I was very happy with. It was kind of like a great, in my eyes, it was kind of like a great business at a sensible or a fair price, but not at a great bargain price. So I actually would have, maybe you could call it unlucky then, because I would have liked to continue to add more as it went down. But yeah, that's kind of the luck component, is I didn't know the timing of whether it was going to recover in 6 months or whether it was going to take 3 years.
And that's the thing for a lot of investors, that if you're pretty young, like if you're in your 20s or if you're in your 30s, then you just got to remember that if you do want to be an investor and really get into this game, chances are you're going to be a net buyer of stocks. This is a concept that Warren Buffett talks about every now and again. If you're going to be a net buyer of stocks in the next 2 decades, then you really want stocks to go down as opposed to going up, which completely goes against what your emotions tell you to believe, because of course I'm sure you are the same, and I'm definitely the same. Like for instance, a Tesla shareholder, and there's no doubt that when the share price skyrocketed up and it's up whatever 200% or whatever it is in the last 6 months or whatever it is, I felt fantastic. But I'm like, hang on, if I believe in this company for the long term, and I'm going to be just in general a net buyer of stocks over the next couple of decades, then I actually don't want this share price to go up just yet. I don't know. Yeah. That's kind of my thoughts on it.
I like Warren Buffett's analogy on this, and it's that when you go to the petrol station or the gas station, you are always a net buyer of fuel. So you always want the price to be going down. And the same is true for almost your entire investing life, is that you are almost always going to be a net buyer of stocks, which means you want, as long as they're great businesses, you want their prices to be as low as possible. But it feels counterintuitive. And there's no doubt that in the same way that you experienced sort of, you get that feel-good feeling with Tesla when it goes up so much, you get the same feeling when a stock goes down 50% after you buy it. The opposite feeling, of course. I mean, if you're kind of a normal human. maybe there's some people out there who just kind of get super, like, I mean, obviously we say we get super excited when a stock goes down, but it's still like a feeling of doubt or something like that.
Something that I focus on, and something that I talk about in my investing courses that I've made, is teaching those new investors about the emotions that you're going to feel. And I never shy away from saying that every investor, regardless of who you are, like, you're just human, so you're gonna feel the emotions. Maybe Warren Buffett's an exception, who knows? But I would say even some of the best investors in the world, they feel the emotions. Like, I've heard, for instance, lots of long-term notable Tesla shareholders, jumping around. Was it Ron Barron was like hop, step and jumping around on TV and clicking his heels together when Tesla was skyrocketing? But the thing that I always say is that the best investors in the world, yes, they still feel the emotions of stocks going up and stocks going down. When they go up, there's joy and elation. When they go down, there's bit of fear. Have I made a mistake? But for the long-term investors, yes, they feel these emotions, but they are still able to make really rational investment decisions. So yes, everyone feels the emotions, but weak investors are the people that feel the emotions and act on them. And then the best investors are the ones that feel the emotions but don't act on those emotions, if that makes sense.
Yeah, definitely. All right, so let's get to this Texas Roadhouse earnings. Somehow we went.
It was a good tangent. It was an important tangent to go on.
That's exactly what I was going to say. I like I really like how we have these free flowing podcasts now, because we can just go on these tangents and hopefully it's sort of providing a bit of value. But
except there was this one time when we went on a tangent and then we never covered the thing that we were going to talk about. I can't remember what that was.
One time, Brandon, we've done that almost every podcast.
Every time. It's like, and we'll get to this a little bit later on.
Yeah.
And then by the end, after we finished recording, we looked back and we're like, hang on, we never talked about that.
Yeah. Whoops, we spoke about Tesla for 40 minutes.
For 40 minutes. Oh, I've even brought it up today. Okay, anyway, moving on. Texas Roadhouse. How many Chipotlanes have they put in this quarter? That's what I want to know.
0 Chipotlanes, but they did have some good results. So in terms of their sales and earnings per share growth, so sales came in at about 12%, earnings per share just under 12%, 11.8%. So excellent growth on the top and bottom line of the income statement. And then one of the sort of numbers that's important to look at for restaurants when we're looking at their top line is not just how much did their overall sales growth, but what was the sales growth in restaurants that already existed, growth from restaurants bringing in more customers and customers spending more money. And that figure came in at 4.7% at company-owned restaurants for the year, which is excellent. That's a really great achievement. I think the industry average hovers somewhere between 1 and 2.5%, generally speaking. Generally comparable restaurant growth, if there's not a ton of new customers coming through the doors, it's going to be in line with inflation, with the cost increases of the menu prices, I guess. So 4.7% excellent, which is good to see. And I kind of use that measure as a bit of an indication of competitive advantage, because if a company restaurant has sales in those restaurants that are growing higher than the industry average, it means that
2 times the industry average.
Yeah, I mean substantially higher. And I think their average has, over the past 10 years, it's been somewhere in the 5, 6, 7% range. So this isn't unusual for them. It's actually probably on the low side. But it indicates that a lot more people are coming back. They're telling their friends, they're going back, and they're spending more money when they go there. But a couple other numbers I like to look at. So equity was down, which generally speaking over the long term, we like to see equity grow. But it was down because they were actually doing some share repurchases last year.
I remember you telling me about that. Yeah.
Yeah. So this is one of those companies where the management team rarely repurchases stock because they just have so many other investment opportunities to build out new restaurants.
Didn't you say the last time they repurchased stock was like in 2008? Before this one that they did? Or am I just making that up?
I believe that was Thor Industries.
That was Thor,
Texas Roadhouse has not made many, maybe 2 or 3 times they've done that over the past 10 years, I believe. Don't quote me on that though. But yeah, so they were repurchasing stock and the average price that they were able to repurchase at was $53 per share. And I think the current stock price is about $66. So they've already done quite well on those repurchases. And funnily enough, their average share, I mentioned this in a video I did on Texas Roadhouse, their average price was almost identical to the price that I invested at, which I thought was hilarious.
That's funny.
Just another coincidence, obviously. I didn't pick 53 wasn't the exact number in my calculation. It just happened to be the day that I was purchasing, but I thought that was kind of funny. So equity down, but it kind of it's kind of a good thing for investors because they were able to reduce the number of shares, increase profits per share, that sort of thing over the long term. And then the last number I look at is cash flow. And cash flow was actually flat year over year. So their earnings per share did grow by about 12%, but due to some short-term liabilities and a couple of other odd things, their cash flows were flat on a year-over-year basis.
Right. Do they anticipate that will be a kind of like a one-time thing?
Yeah, it's more of just a relationship between the cash flows that were a little bit higher last year and then a little bit lower this year, whereas the earnings figure is kind of more of a, I guess, a smoother picture of their growth in earnings. But if you look at their cash flows over the long term, I can just pull it up here. Their earnings per share have grown at 13% compounded over 10 years, and their cash flow has grown at 12%. So over multiple periods, they're pretty much the same. It's pretty just consistent in the short term. That tends to happen with businesses. Yeah.
Oh, nice. That's pretty good. So you're happy with that?
Yeah, I am happy. And yeah, I mean, as I mentioned, I would have liked to have gone down further, but I certainly can't complain with a 50% turnaround in 6 months. So,
yeah, I was just looking at the chart just then. It's quite phenomenal.
It's quite dramatic. And it looks so similar to sort of what Facebook did as well. Those are kind of the opportunities that I tend to try to exploit and that I try and sort of help people exploit on my YouTube channel and that sort of thing, because it's just so much short-term fear that drives the stock price down. And as long as it's a great business, as long as you've done the calculations about what you can get out of it in the future, then it makes perfect sense to go in, even if it's going to fall another, 20, 30% after you buy it. If you get it at the right price, it makes sense.
It's one thing I always used to kind of be a little skeptical about when I used to hear people say, or even people like Warren Buffett, all short-term people, the short-term drives stock prices. And I used to be like, yeah, but like how much? And the more that I've obviously learned about investing over time, the more I've realized that actually short-term news really does drive stock prices. I mean, it's crazy. Just even in the short time that me and you have been investing, just how many examples we've seen of extremely short-term news having really significant impacts on different company share prices. Like you bring up the whole idea with Facebook there. There was the Cambridge Analytica thing. There was a time where the stock price was tanking because I think something like 90 million accounts were found to be vulnerable, and that sent the shares down like 10 or 15% or something ridiculous. But I mean, it's just all these really short-term views that have like staggering effects on the share price movement. When you think about a stock as a business, like as a fully fledged functioning business, it just seems crazy that you come out with this little bit of news and it can change the share price of that business by 10, 15, 20%. It's like, is the business 10, 15, 20% different?
Yeah.
No way.
I mean, to just keep going on Facebook, because I think Facebook was just way too dramatic. It was a 40% drop. And there was so many articles during that time saying Facebook wouldn't be around in 5 years. It won't be around in 10 years. That's absurd. They control 40% of the online ad revenue market. That's crazy. That's not going anywhere. And their algorithm...
they have 2.4 billion monthly active users.
Yeah, like their algorithm is so good for small businesses in particular to get access to a lot of customers very cheaply. It's a huge problem that has been solved. Prior to that, good luck if you're a small business advertising to a broad market and scaling up your business. What are you going to do? Take out a newspaper ad? Buy a billboard? You have no idea what kind of return you're going to get on that investment. Facebook ads, it tells you. It tells you exactly how much you spent to acquire a customer, how much you got from that customer, and whether it makes more sense to increase your budget. It's
a good example. It's just crazy. Yeah.
Obviously, just
it's crazy how this short-term stuff can impact different businesses so heavily.
Yeah.
All right, I want to move on now because we've got some really big news stories to talk about this week. One of the most notable news stories, if not the most notable news story of the week, was kind of a little bit out of the blue, not completely, but it certainly took me by surprise, is that Disney's CEO Bob Iger has stepped down effective immediately. So he is going to stay on because his contract expires in 2021. The reason I say it's kind of expected but kind of not, the reason that's kind of expected is he's been very open and honest that he says, look, he is retiring in 2021. He's been with the company for decades and decades, so he it's time for him to retire. So everyone's kind of accepted that, but they didn't expect him to step down as CEO. They just thought that he would run out his contract as CEO until 2021, and that would be it. He is stepping down as CEO, but he is staying on as a creative director. So he wants to stay until his time's up. He wants to, at Disney, I mean, not until his death. He wants to still be very involved in creating really great, or overseeing the creation of really great content by the assets or the brands that Disney owns, which a lot of them he has overseen or been the facilitator of acquisitions of those brands. So he still very much cares about the content and the company, and he wants to see it thrive until his contract's expired. He's being replaced by Bob Chapek, who has also been with the company for a very long time. Most recently served as chairman of Disney Parks Experiences and Products. So he's very much, up until now, obviously, very much focused on the theme parks, but now he's stepping up. He's been working very closely with Bob Iger for, I think, 15 years at Disney. So... and plus people, like, obviously the market's reacted badly because, I mean, who's going to replace Bob Iger? He's flipping awesome. But yeah, I think that Disney shareholders shouldn't be too worried because, I mean, Bob's still there, and they were talking about, Bob Chapek being able to talk to Bob Iger whenever he wants to, to get feedback and ideas and help.
Yeah. I can't say I was expecting that either. I think you were the one who sort of brought my attention to that. But it does kind of bring up an interesting conversation about just investing in general and what role management sort of plays in that. Because whenever there's a change in management, if you're an investor, you need to make sure that you've sort of done your due diligence when it comes to the new CEO. Because the past 10 years of Disney is in... A large part of their success is attributable to Bob Iger.
Definitely.
So
Definitely.
It would be fair to say that a big chunk of the success of Disney in the next 10 years will be in relation to the new CEO. What's his name? Bob Chapek? Am I pronouncing that right?
Yeah. Chapek, yeah.
So, and it's good that he's been at the company for a long time working with Bob Iger. That's obviously a great sign. But I'm certainly curious to see how he takes over and what direction he takes Disney in the future, as it's it's a bit of an inflection point for Disney's business in general as well, with sort of a transformation from traditional media to online media to streaming services. So it's going to be fascinating.
Exactly right. And I think it's fair enough that Bob's stepping down, and Bob Iger is stepping down. Bob Chapek was saying in this interview, of course they're going to say this anyway, but I still felt kind of reassured that he was saying this, is that he asked, is there going to be any dramatic change now that you've got the reins? And he basically just said, look, no, I think that the work that Bob Iger has done over the past, decade or so has really set Disney up for long-term success. So in the short term, at least, he sees nothing really changing. He's going to keep working on, developing the brands that they've acquired. He's going to obviously keep working on pushing the direct-to-consumer streaming service product and building that up to the best it can be. And then he says that, look, we're always looking for disruptions in the marketplace. So if there are any big, opportunities to come around, then we won't hesitate to kind of act on them and try and keep up with the changing kind of entertainment industry. Which I think is good. I mean, it's kind of like, yes, I'm going to be obviously honouring what Bob's worked so hard to achieve, and if we need to, we'll take it in new directions as we see them pop up.
Maybe this is a good time to discuss some of the things Iger's done for Disney.
He's done a lot.
Couple of decades.
I guess he's been a very good manager. You could look at the kind of financial results and that sort of stuff, and you probably see that he's done very well as a CEO, as a manager of the company. But I think some of the most notable things have been that he's done have been based on just overarching business strategy, because I think that some of the most important things that Bob Iger has done is he's made some big acquisitions. So he's acquired, Disney, during his time as CEO, Disney acquired Marvel. They acquired Lucasfilm, which is, of course, Star Wars. They acquired Pixar. They acquired 21st Century Fox. So that's really I think that in itself is a very good achievement, because Bob Iger's plan was definitely like, okay, we need to, in the entertainment industry, we need to have that brand power. You know, we need to have, you know, what are people watching? People love Star Wars. They love Marvel. We need to, you know, they love Pixar movies. We need to get the brands, or get the rights to own the brands as to where, you know, people's views are going. So I think he's done extremely well in doing that. And the other thing that he's done is he hasn't kind of sat back and seen the rise of streaming services and just kind of let it go. He said, you know what, we are uniquely positioned with all the content that we own to create a really good direct-to-consumer product. And he's taken action, and he has now worked to bring us Disney Plus, which now brings all of the past Disney content that just Disney had, like all their Vault films, whatever, you know, shows from the Disney Channel and all that sort of stuff, plus Marvel, plus Star Wars, plus Pixar, plus National Geographic, and chuck it all into this direct-to-consumer product. Whereas before, they would just license that content out to whatever it might be, a Netflix or something, and then Netflix would get the revenue mostly from that process. So Bob Iger's done a good job in building this streaming service, where he's like, actually, no, we're going to build the program, and we're going to directly get our customers our money.
Yeah. And the reality is, when it comes to the decisions that a manager like Bob Iger makes, the numbers don't lie. Like, the numbers show us whether the collection of those decisions accumulated over time has resulted in, for example, a higher return on invested capital. Has management gotten more effective at making decisions over time? And if I just pulled up Walt Disney's return on invested capital over the past 10 years, and it's basically a straight line upward, meaning the percentage return they generate in terms of cash flow on their long-term investments has consistently increased. In 2009, it was at about 8%, going up every single year progressively, to the point where in 2018 it was 15.5%. So they have progressively gotten better at making investment decisions, and that's exactly what you want to see as an investor.
I wouldn't be surprised if that return continues into the future, because they've been obviously quite strategic as well. Marvel has been a brand that has been popular for a very, very long time. Think about Star Wars. When did the first movie came out? In the 70s. They've been such popular brands. Even Pixar, for example, they've been such popular brands. They've stood the test of time. So it's very smart kind of acquisition in that sense as well, in kind of future planning as well. If they've been great brands and have drawn viewers, drawn attention for, 30, 40, 50 years, then there's no reason not to believe that the content that we make under those brands in the next 20, 30, 40, 50 years will still stay popular.
Yeah, and the business model that they're now sort of they're going to be relying on heavily in the future, which is streaming services, is a lot less capital intensive than some of their other businesses. So not only have they been more effective, not only has Bob Iger been making good decisions when it comes to acquiring brands, but they're also transitioning into a business model which will again make them, or should again make them, more efficient.
Yeah.
So it's certainly, I mean, it's a search.
I like it.
It's an interesting. I always end by saying this. What's our catchphrase?
Oh, what is it?
We'll tell you next week or something. We'll find out. Find out next week.
We'll have to wait and see.
Yeah, we'll have to wait and see. That's it. So we'll have to wait and see what happens with Disney and the streaming wars.
That's exactly right. Yeah. Shall we talk about this next news story? We will have to wait and see.
We will have to wait and see. Yes. So let's talk about. Should we talk about Warren Buffett and what happened this week? So his shareholder letter came out, and then he also had a CNBC interview, which is about 2 hours long. It's on YouTube. Go watch it.
Definitely go watch it.
Tons of value in there.
Yep.
Yeah,
so I had a bit of a read. I'm a slow reader, so I was reading it this morning. I kind of had to skip through it a little bit. I definitely, if you're someone that's relatively new to investing, I definitely recommend you go back and read just Warren Buffett's annual letter to shareholders. They're available to anyone to read just on Berkshire Hathaway's shitty 1990s website that they haven't updated in 15, 20 years or whatever. But the first, so definitely go on and just check him out and just read him, because there's just so many gems from a really smart, really rational investor in Warren Buffett that you can really learn a lot from. It's really like a free stock market investing lesson each year that we get, essentially. But one of the first things I noticed, which is on page 1, which is why it's one of the first things I noticed, was that since 1965, get this, Berkshire Hathaway has made a gain of 2.7 million %.
Whoa.
How nuts is that? It's pretty phenomenal, right?
That's compound interest for you.
Yeah, exactly right. The S&P 500, for comparison, has made about 20,000%, which is still very good and averages out to, I think, about a 10% annual growth rate or something like that, 10% annual return. But it's certainly not 2.7 million.
It's not 2.7 million. It's just incredible. And I mean, he kind of touched on this throughout his letter and in the interview about how important retained earnings is. When it comes to the compounding of a stock price. Yeah.
And it's interesting. And the thing that he noted to shareholders is, remember that, for Berkshire Hathaway, so their business is they own a lot of businesses completely that are 100% owned by Berkshire Hathaway. And then, of course, they make investments in other businesses where, they would like to buy a controlling interest, but they just can't. So one of the interesting things was, he noted that if you're a Berkshire Hathaway shareholder or looking at the Berkshire Hathaway financials or quarterly or annual data, is that you'll see you'll see their operating income from the businesses that they wholly own. You'll see the dividend income coming in from the businesses that they own. But something that is extremely important that you will never see in their financial data is the retained earnings that are, obviously retained by the companies that they have substantial holdings in, because he says how important the retained earnings are for those companies to make that investment work out for Berkshire Hathaway in the long run.
Yeah, and I mean, retained earnings, and this is kind of based off Warren Buffett's principles, but retained earnings over the long term, the compounding of earnings within a business, should be reflected in the stock price over the long term. And I think Buffett's mentioned that, yes, this will sort of come through in our results over the long term when the stock prices reflect those retained earnings. But in the short term, it often doesn't reflect that. And it brings up an interesting sort of conversation about the compounding of earnings. A lot of people really are die-hard dividend sort of fans, I guess. They love companies that pay out a lot of their earnings as dividends. And then there's people like Warren Buffett Berkshire's never paid a dividend. They've done extremely well because they are very good at reinvesting within the business. It's kind of like, the way to think about it, or the way I think about it, is retained earnings is like having a savings account and leaving the interest in there. So if you earn 2% interest and then you don't take the interest out, that interest is earning interest on interest. And the same thing is true for businesses. If they retain earnings and they can reinvest it back into the business to grow the future earnings of the business, then that over the long term should be reflected in the stock prices of those businesses, which is, of course, a benefit to Berkshire owners.
Yeah. And will most likely outperform whatever you could do with the fat dividend that they just paid you. I mean, most people would, get dividend payments and just spend them as opposed to reinvest them. So it's just like, it's kind of nice companies with, good growth companies with retained earnings. It's kind of like the company itself is forcing you to get a good compounding effect going. But they're just doing that within their own business, as opposed to giving you that money for then you having to sort out your own compounding effect.
Yeah, well, if a company can generate, if they have investment opportunities in front of them and they can generate a 15 or maybe even higher return on retained earnings, then you absolutely want them to keep that within the business, because if they pay that out as a dividend, not only do you have to go and find an investment that can generate a better return than those internal investments of 15, 16, 17%, but it's also highly inefficient in terms of tax, because you have to pay tax on that, and then you have to go and pay brokerage fees to buy it, and then you got to sell it. it's so much more efficient if the business just keeps it in the business, reinvests into them, into their own products and services, innovation, that sort of thing, grow the earnings internally, and know it's not going to be as smooth. The stock price movements is not going to be as smooth as a dividend might be over a 5-year period, for example. The stock price goes up and down, whereas a stable dividend company might pay a consistent dividend over that time. But you will by far probably do much better in terms of overall returns if you can sort of get through those ups and downs.
Yeah, if you just keep an eye on the long term, exactly right. Yeah, because you bring up a good point. It's really inefficient if you're taking on dividends and that sort of stuff. It's much better if you're in a good company, just keep the money in there and let them continue to use it. I mean, as well, companies that, this is the thing with dividend investors that sometimes I really get frustrated with. Some dividend investors, they're in these great companies that are growing really well, making great investments back into their own business, and they're still harping on that they want more of a dividend. It's like, come on. It's like, if they pay more of their earnings out as a dividend to you, sucker, then you are hampering that business. It's like if they're showing that they can get, for every dollar that they reinvest in their business, they can get a 15% return on it, then don't take the dollars away from them. Don't ask for those dollars to be distributed to you. Let them continue to do that, because if you are a long-term shareholder and you're going to try and hold a business for more than a decade, then if you can, like you're saying, ride out the bumps, then you should see a massive increase. If they can keep that compounding effect going within their own business, they'll see a massive increase in the value of that business, which you would imagine over a long period of time will be reflected in the stock price.
Definitely, yeah. And I mean, as Brandon said, go out, watch the interview, go read through the letter. There's tons of stuff that we just won't have time to talk about. But one of the things that I always like to highlight is that something that Buffett always says in almost all of his letters. And he basically said, we constantly seek to buy new businesses that meet 3 criteria. And his 3 criteria are high return on net tangible assets, run by able and honest managers, purchased at a sensible price.
That's it.
And that's it. That's the simple strategy, or it's simple on paper, harder to execute, but simple strategy that he's been using and talking about, lecturing about, I guess, for so many years. And really, it's businesses that can compound money within themselves at a high rate. That's that high return on net tangible assets. Can they generate a lot of profit on a small amount of investments and reinvest consistently? Is management honest? Are they going to make good decisions like Bob Iger has over the past 10 years or so, or 20 years for Disney, and then buying it at the right price, not overpaying, working out what is the expected return of that business? What can you actually get out of it given the current price that the market is offering you? It's really simple steps, and I wish more people kind of tuned into it. I don't know, it still seems more popular that people are interested in discussing the short-term goings-on of companies and markets, but I don't know, do that for 40 years and see how far you get. But here's a quote for you that kind of backs that up. He's talking about after listing all of the stakes that Berkshire has in other publicly traded companies. He says, Charlie and I do not view the $248 billion detailed above. That's the total amount that they've got in different companies out there that they don't wholly own. Charlie and I do not view the $248 billion detailed above as a collection of stock market wages, dalliances to be terminated because of downgrades by the street, an earnings miss, expected Federal Reserve actions, possible political developments, forecast by economists, or whatever else might be the subject day to day. What we see in our holdings, rather, is an assembly of companies that we partly own and that, on a weighted basis, are earning more than 20% on the net tangible equity capital required to run their businesses. These companies also earn their profits without employing excessive levels of debt. Returns of that order by large, established, understandable businesses are remarkable under any circumstances. They are truly mind-blowing when compared to the returns that many investors have accepted on bonds over the last decade, 2.5%, or even less on 30-year US Treasury bonds, for example. Yeah, I mean, that's the thing, is that interest rates are so low, and Buffett spoke about this in his interview, that interest rates are so low, it's like you're paying 50, if it's 2%, you're paying 50 times the earnings. So buying a bond is the equivalent of saying, I'm buying this stock at 50 times earnings, and I know that the earnings of this company are not going to grow in the future.
Won't grow.
That would be insane. That would be an insane investment, but that's kind of the yardstick or the standard that you're comparing against, and it's why stocks have roared so much, because the alternative just sucks. It's terrible.
It is
2%. You could even if you make 4 or 5% in stocks, you're going to do better than bonds. Yeah. So it makes sense to pay up for them in the short term. And of course, the opposite side of that is that if interest rates do rise, then the yardstick rises, the standard rises, which means that you have to be generating a higher return on stocks for them to make sense.
Yes.
Meaning stock prices can come down. And that's why Buffett's holding so much cash, is because he's anticipating that something like that is likely to happen, or it's a possibility to the point where he wants to have cash around.
He wants to be ready for it.
Exactly. Yeah. And that's kind of been his strategy for a very long time, is keep enough cash around so that you can reinvest if stocks get cheaper. But he's always a net buyer, because he always believes that stocks are going to do better than any alternative. And of course, by stocks, I mean the ones that he has determined are great businesses, not just, throwing a dart at a board and picking a random business.
To give us a little bit more context when we're talking about this, so Buffett has $248 billion worth in the market, okay? But when we're talking about holding cash, he has about $130 billion out of the market. Now, granted, he's said before that $20 to $30 billion of that is untouchable money, as kind of like an emergency fund for Berkshire.
Yeah.
But still, it's pretty crazy that when you look at just like percentages, it's basically 2/3 in the market and 1/3 out of the market.
Yeah, and
which is a high, like for a massive company like that, that's a high level of cash to be holding. So
yeah, and that's not a result of him being a net seller. It's not as if it's not as if he thinks, oh, market's going to downturn, so I'm starting to sell stock and get more in cash. It's just a matter. He's always a net buyer. Yes. I think he said he's been a net buyer every year since he was 11. I think that's what he said in the interview or something
exactly
like that.
Right. Yeah.
It's more of a fact that he's not finding enough opportunities. Like the money coming in from the businesses or his income source, or if you're an individual investor, it's your income source from your job. The money's coming in faster than he can find opportunities to deploy it.
Yes.
And that's kind of why it's building up. And that's sort of been what I've been experiencing for a while now as well. And I think a lot of investors are experiencing that. There's occasionally opportunities that I can exploit, but just not enough. Not enough that I can that I would find myself 80-90% in the market. Just not at the moment, at least.
Yeah. Yep, that's it. But no, there's so many good gems out of that interview on CNBC, and also in his annual letter as well. I mean, there's so much stuff that we could touch on, but we probably just don't have time. Like, he went on a rant about director compensation. And he was for instance, he's staggered that these days, a director could earn $250,000 to $300,000 annually just for showing up at board meetings, which might take up a few days of the year. He was saying, what is it? A director might earn between 3 and 4 times the annual median income of US households. It's pretty crazy.
Yeah, that's insane. One thing I did want to mention that's not related to Buffett, sort of moving on now, but more in relation to the short-term turbulence in the markets and the global economy, is that the Australian dollar is very, very weak at the moment. It's the weakest it's been in 10 years. And
wow.
It's currently sitting at about 65 Australian dollars, US cents, $1, US dollar, 60.
No, one
Australian dollar.
US dollar, wait. $1 US equals 65 Australian cents.
Correct. Okay. Yes. So yes. Yeah, but
I get confused with that all the time.
It always messes me up because I always look at the other one, which is the 1.4, which goes the other way.
We are not. Yeah, I look at that one as well. Let's put it this way: we are not doing too well in Australia.
Yeah, and one thing I did want to mention on this story, which I thought was fascinating, and this might be fascinating for some people as well, is that this is actually really good for Aussie investors who have money in US dollars or US stocks. So
yes,
many people would be aware that most of the positions that I hold are in US stocks. And on top of that, I also hold quite a lot of US dollars just to sort of balance out between having US dollars and Australian dollars.
Right.
And that means that as the Australian dollar weakens against the US dollar, you benefit from currency exchange. And I just, based on this story, I just pulled up my my portfolio to have a look. And this is over the past year, the past 12 months. I have multiple investments that have gained 8 to 9% in the last year on currency alone.
That's crazy.
Which is really high.
That's crazy.
That's insane to think about. I think my portfolio overall had gained about 5.5% on currency over the past 12 months, and about 9 or 10% over the past 3 years, which is it's a lot.
You've got a decent annual return just on currency.
Yeah, it's fascinating, isn't it? It's amazing, and that's obviously something unpredictable. It's not something I planned on, and it's not something any Aussie investor who was buying US stocks would have planned on. But it's fascinating to watch. And
it's true. Yeah. Yeah. No, I'm experiencing the same. You're right. I'm like the same as you. I find interest in the US companies. So yeah, naturally a fair bit of my money's over in my stake account.
Yeah.
And yeah, if I wanted to draw it back into Australian dollars right now, then we'd be sitting pretty. Yeah. That's for sure.
That's the other thing as well, is that I'm not obviously realizing that gain because they're in US stocks that I'm going to be holding for a very long time. So it's probably more than likely that we'll see some movements in both directions for the Australian US dollar. And if the Australian dollar improves against the US dollar, then that will be, that'll result in, if that happened next year, for example, that would mean I would have negative currency exchange, which would reduce my overall returns.
And to be honest, talking about this whole concept of being a net buyer of stocks, if you know that you're going to be a net buyer of US stocks, you actually want that exchange rate to switch and go the other way, make it more favorable for you, because we'll keep earning money from our income, whatever we do for work and our businesses, and we want to put that money to use. And if we put it to use in US stocks, then we want that. We want to get as many US dollars for our Australian dollars as we possibly can, so we can put them to use over in US companies.
Yeah, definitely. It's kind of the case of up is good, but in the short term, not really.
We're feeling good right now, but in reality, I don't plan on moving US dollars back into Australian dollars because it's over in the States invested in these companies. So.
Yeah, and because the Aussie dollar is so weak now, any investments that I make now will almost certainly be negatively affected by exchange rate over the long term. Whereas the investments that I made prior to this kind of decline are benefiting.
Yes.
So you're right. It's kind of like the opposite of what you would want if you're a net buyer, which you should be a net buyer most of the time. Don't be a net seller ever, guys. Don't do it.
Yeah, literally don't. I mean, I was looking at some of Warren Buffett's positions. He's never sold a share of Coke. He's never sold a Coke share ever. He's accumulated 9.3% ownership in the company. He's never sold a share. And this is the power of long-term investing. His total cost has been $1.3 billion. And that position is now worth $22.1 billion.
Yeah, and talk about discipline. The man waited. He had loved Coca-Cola since he was a child. He loved the company, but he waited till he was in his mid-40s to start buying it. Talk about discipline. That's pretty you good. Seeing a company now that we've grown up with. Maybe it's a social media company, but it's too expensive. And having the discipline to wait 20 years just for the relationship between the price and its earnings to get good enough for it to be a good investment.
To be an attractive investment.
I mean, of course, in hindsight, it would have been better for Warren Buffett to have purchased Coca-Cola earlier, but it's about having the confidence based on the relationship between its price and its earnings. Coca-Cola has for a very long time been very expensive just because of its brand power.
Yeah. If he'd bought earlier, he would have done better on that stock, but I think overall he would have done worse, because if he'd bought earlier, then that would indicate to me that his strategy is don't wait until you have a margin of safety price, which probably would have led him to make some terrible investments into the future, which probably wouldn't have led him to be the world's best investor that he is today.
That's an excellent point. That's the best way you could have phrased that, is that it's about having that discipline, even though in that one investment he might have done better in hindsight, would it have shaped his investment decisions that would have overall cost him a lot more money? That's a really good way to think about that.
And with that said, I reckon that's a pretty good time to wrap things up for this week. We've been talking for about an hour or so. So thanks always for joining me.
Thanks,
we'll have to make sure we get to more Q&A questions next week.
Definitely.
And even today, we've had so many questions that, topics that we still haven't been able to cover. But I think it was good just kind of pacing ourselves and diving deep into the topics that we did talk about today. So I think that's where the value of the podcast lies.
Definitely, yeah. And if you're wondering why, if you're looking for where The Young Investors has gone on YouTube, it's no longer on myself or Brandon's channels. It now has its own home on The Young Investors. What's it called? The Young Investors
Podcast
YouTube channel. I don't even know the name of it. That's terrible.
Oh my gosh. Well, I mean, come on. You could have had a guess on that one.
Yeah, I could have had a guess.
We do this podcast. It's called The Young Investors Podcast. We made a YouTube channel for it, guys. We made a YouTube channel to host the podcast, and it's called
2 + 2 = Young Investors Podcast. Bingo.
Go if you want to submit a question to us for us to talk about on the podcast, then go over to the Young Investors Podcast YouTube channel and just drop it in the comments section of the latest video up there. And subscribe.
Yeah, you have to subscribe. If you don't, we'll find you.
Yeah, we'll find you and we'll take your entire stock portfolio. So there you go. So you better run over and subscribe right now. Otherwise, this will be Saturday. So in 3 days' time, your portfolio will be down to zero. Yeah, that's right. Gone. That's right. Don't say I didn't warn you.
We've got that power.
Yeah. I'll be, if you don't subscribe, I would be sweating bullets on Monday, let me tell you. But there you go. enough threatening. But of course, the podcast continues on Spotify and Apple Podcasts and all those places. But I think that'll do. I just got a message literally just then from Tom, investing with Tom. He said, "Boys, fishing chat was 10 out of 10 on the podcast last week. That's more like it."
Good.
I'm glad that you enjoyed the fishing chat, Tom. He says, "Personal best tuna this week." No, not this week. Not this week,
unfortunately.
Unfortunately, I live in Canberra, so we've only got a lake, and the tuna, they're just not as big in the lake, All right, we're rambling. We're out of here. Thanks for listening, guys. We'll talk to you guys next week.
See you guys.